Well, good afternoon. We are going to talk about bonds today. We're going to talk about fixed income because it is, you can all hear me, okay. It is a hot topic and there's lots to talk about. As you can see, the title of my talk today is, It's Back to the Future for Fixed Income. And I've got a slide for us. I think most of you, if not all of you in the room, should remember this billboard from Michael J. Fox's movie, Back to the Future. Because I think that's where we're headed, back to the future, to a rising rate environment, which is somewhere that we've been before, but haven't been for a very long time. So today I'm going to talk about how the markets might respond as we move into a rising rate environment, what the markets and what investors should be thinking about in terms of positioning their fixed income allocation, and then where I do actually see value and opportunities in the fixed income markets today. What I especially enjoy about this slide, though, is the license plate that says out of time. And I think that's exactly where we are. So much of the focus this year has been on the actual timing of when the Fed gets off the zero bound and starts raising interest rates. And I say get off the zero bound intentionally because I don't view the Fed's next actions as tightening, but really a return to normal, that the markets need to get back to where they were before. And the out of time represents the fact that while they've been saying that they're ready to begin raising rates, they really threw us a whopper in September when they went on hold. And my view had been, I care less about the actual timing. I'm confident that they're going to do it. What was very odd about September was the additional parameter characteristic that they were on hold because of global volatility. And I don't know about you, but I think global volatility is here to stay. So if we're going to wait for global opportunity to go away, we're going to be stuck here for a long time. And I simply don't think that's the case. So I have a much brighter view of where the global economy is, and we'll talk about that. I also am very optimistic about where the U.S. in particular is headed. So yes, we're out of time in terms of moving forward and getting interest rates back to normal, but I do think that is where we're headed. So the next slide here is essentially a 60-year view of the 10-year Treasury. And one of the reasons why I do think we're embarking on a secular rise in interest rates is that, yes, interest rate cycles are very long. In fact, my career really began at the peak. So I've enjoyed the tailwind of a declining interest rate environment. But as we've gone beyond 30 years, and if you look at where rates are today, knowing that short rates are zero, I would argue that the odds favor rates moving up. And I think they will because I do see signs of strength in the U.S. economy. The consumer, the private sector has delevered. We're seeing consumption pick up. We're seeing the labor markets tighten. All signs that the recovery is progressing as you would expect. So the next move should be higher interest rates. But in terms of thinking about how that's going to look, I would expect that what the Fed wants to do is to move interest rates up gradually. That it's important to take time to assess the strength of the economy. While I do see lots of opportunities out there, I think the challenge in moving interest rates up is that we've been in this zero interest rate environment for a very long time. And the challenge that lies ahead is in how capital and the markets react to going back to normal. But I would say that looking at this slide, the end of the bull market is here, and actually what began in the spring of 2013 with the taper tantrum is the beginning of this move up in interest rates. Now the challenges for the Fed and all the central banks are global. That after the global financial crisis, I think the global economy was faced with a challenge to get growth going. And every region of the world has responded in different ways. So the challenge of the last 6 years has really been a balancing act between the developed world and the developing world. And I illustrate that with the globe and the shifting tides, because what we're on the forefront of is a shift in capital, that large movements in the market come from changing environments. We've been in a low rate environment for a long period of time. Investors have decided that there really are two ways to manage in a low rate environment, especially an environment that was created because of the financial crisis. So you've had two camps of investors. One camp coming out of the global financial crisis that simply said, okay, rates may be going up somewhere down the road, but I want to preserve capital. And so the best defense for a rising rate environment and preserving capital is simply to go short duration. So there's been a lot of money that has flowed into fixed income, high quality fixed income at the short end in order to preserve capital. Now, it's been there and capital has been preserved, but at a huge opportunity cost by forfeiting income. I think a lot about what the waves will look like when the market does begin to get off the zero bound, because that is very complacent money that is risk averse. And when fixed income begins to move at the short end, as the Fed begins to move, 25 basis points here, a bit of a pause, 25 basis points later, a bit of a pause, is the perfect, ideal, gradual path for interest rates to go in and to calm investors as we adjust to normal. I think the chances of that happening at this point, because the Fed did not move in September, have been taken away. That essentially the Fed is now in a very tight box with little flexibility because of those positives that I pointed out about the US economy. Growth is there, the labor markets have hit the objectives that the Fed wants, and wage pressures are building. That is a big issue. And the tailwind, the benefit for consumers here in the US as well as in Europe has been the benefit of low energy prices. That appears to be turning, and I'll talk more about that because I would like to see that turn happen. But as the inflation pressures overall in the economy begin to build, I believe the Fed has gotten behind the curve. And if we get a government shutdown or an issue with that in December, it really shrinks the flexibility that the Fed has. And I think there's a risk that the markets will force the Fed's hand. And rather than having a gradual, taking their time, letting investors, particularly those investors who have been preserving their capital, the response that they will give the markets is, gee, I didn't know that my high quality bond fund could generate negative rates of return. What other opportunities are there that exist today? So that I think is a challenge for the market. And then on the other side of it, what's really created this dynamic of risk on and risk off for the last several years is that there are investors in a low rate environment who've said, I think the fundamentals are positive and I need income, so I'm going to reach for yield. And I think everyone in this room knows that reaching for yield tends to end very badly. And for bonds, it's simple because it's simply bond math. A coupon, a maturity, and the level of rates. And we see the level of rates moving up. Even if it's just a return to normal, you do the math and prices have to go down. So some of those areas, high yield, not all of high yield, because we've seen spreads widen through 2015, but traditional new issue high yield still carries a low coupon in an absolute sense. So as rates at the short end rise, you're going to see, I think, potentially some air pockets in the high yield market. So capital has been stuck in these key areas, and it's likely to start to move. And that's part of the balancing act. How do the U.S. fixed income markets respond to the change in interest rates? And then there's a question of what is the impact for the rest of the globe. So these are the challenges that I think we face in the next several months. But I also want to say, as I point out that they are challenges, with every challenge, you do find good opportunities. Credit overall has not been cheap, at least in terms of investing in fixed income. Borrowing, on the other hand, has been cheap. But investing today, I think when you look at investment grade corporate and traditional high yield, the absolute level of yields is overvalued. I think the process of getting rates to move higher will bring us lots of opportunities. So investors, in terms of what they want to think about with their fixed income, I think is thinking about more flexibility, because bonds are more than just interest rate sensitive securities. There are lots of different fixed income securities out there, and an approach to fixed income that has greater flexibility, that pulls a variety of different levers, I think will be very helpful to have in a total portfolio allocation, because the levers of credit, if you're getting paid for it, and country and currency, in addition to interest rate risk, are going to be the tools that we need to operate as interest rates go forward into that secular rise in interest rates. And I mentioned country and currency because I think the world itself, with this balancing act, is changing. The taper tantrum in the spring of 2013 took a lot of momentum out of emerging markets. But emerging markets are going to be a big part of where there will be opportunities down the road. But I think our definition and the way we as investors think about emerging markets is going to change. That it really is going to be about regions of the world and really focusing on country-specific fundamentals, economic policy and politics as areas of the world begin to become more mainstream. If you picked up the Financial Times today, the lead story is about China issuing renminbi denominated securities being issued in London. That's going to be a big part about the bond markets going forward. You're going to have choices in terms of rates, sovereign credit, and currency. Greater flexibility, more levers to help manage in a global economy that is going to pick up speed over time. But for now, we're stuck where we are, slow growth, getting faster, looking to get back to normal. So I mentioned the transitions that I think are facing the markets, the first being here in the US with that normalization. And keep in mind that that normalization isn't a tightening, but it's an opportunity for the economy to get to a level where I think one of the missing pieces in the economy has been the lack of investment spending. We're seeing a lot of cost cutting. We're seeing M&A activity, which is generally the next stage in recovery before companies move on to actual investment and we get back to good organic growth. And I think that's just the juncture that we're in, that we're about to be in an environment where investment spending picks up, and a strong motivator or incentive for corporations to start spending will not be zero money, but it will be interest rates that have moved up a bit. There was a survey done sometime last year with a small sample of CEOs, but essentially 100% of them said they would prefer to have interest rates at 3% than at 0. It's a strong motivator to get the economy going. And I think that is why it's so important for the Fed to essentially rip the Band-Aid off with what the fears are that everyone is thinking about and get going so we can get the economy growing faster. So that is one scenario, one transition that I think lies ahead of us. The other transition that I think is important to talk about for the markets today is the transition that we're seeing with China. And I think that's an important transition, partly because the fears of a hard landing in China have weighed heavily on the markets this year. In particular, we saw quite a bit of concern and volatility in July and August. I think the market got very close, if not formed a bottom in August, with the tremendous fear that we saw in the market in regards to China. But I think the mistake here is that most investors have applied a Western lens. They've been thinking about this from an American perspective and don't understand what Chinese policymakers are trying to achieve. So we had fear about market volatility in their equity market, and we had a lot of fear about the devaluation of the renminbi. A lot of folks thought that policymakers were panicking. Well, if we take a step back and look at a few key signals, I think what we'll find is not that China is headed for a hard landing, but they are facing a huge transition. And they have been quite transparent about what that transition is. They are moving from an economy focused on exports to one that really relies more on domestic consumption. Now, with an economy that size, that's not ever going to be an easy transition. And I think we're all well aware that the export orientation and the focus on infrastructure building has led China to a point where there is a tremendous amount of excess capacity. And that's part of the reason why we saw pressure on commodity prices throughout 2015. But it's only just a piece of it. They are committed to reducing that emphasis on manufacturing, but it's going to take time. So then if you look at what did they do in the beginning of 2015, what they did, there had been a number of headlines and forecasters who have said there's a bubble brewing in China. Yes, they have a lot of debt, and a lot of that debt resides with the SOEs, the state-run organizations that have built up a lot of the infrastructure. Those SOEs had special investment vehicles that took on a lot of the loans to help build the infrastructure. And there is a question about how that debt is going to get paid back. But what they did, what the Chinese policymakers did in January, is that they instructed those SIVs, the special investment vehicles, to shut down and transfer the loans to the regional banks. Off-balance sheet liabilities moved on balance sheet. Now, not in a way that I would be okay with. I think that most of us would be horrified because the banks took on new debt. They exchanged the loans for new debt that had a much lower coupon and a much longer maturity. That's not how we do things here in the US, but in a command and control society, that is their way of creating some transparency and restructuring that debt burden at the same time. I think eventually, and this is where we get to the events of July and August, I think that expanding their capital markets, both equity and debt, is going to allow them to achieve many things. One, to bring in foreign investment, to have foreigners own their securities, and eventually be able to transfer to equitize the debts that are now sitting on the regional banks so that they can effectively de-lever. That's not going to happen overnight. It's probably not going to happen in 1 or 2 years. But that's what you look for in China, that they take baby steps, and it gives you a strong signal of where they're coming from. And the devaluation of the currency is really about that long-term agenda that they want to, in the end, their long-term horizon, and I thought I was a long-term investor, is 2050. They want to restore the image, the influence, the power of China from 2,000 years ago to get there by 2050. So they want stability. And I think the steps that they took this year are going to allow them to achieve that stability. And that is what starts to change the global growth picture that the market has been fearing and worrying about for much of this year. I think if you get the US normalizing rates, Europe following us in recovery, and China finding their footing, finding a floor, and achieving stability, it's going to benefit the global economy, and the markets will respond. So 2 really critical transitions that lie ahead for us in the next several months. In October, I think the day last week that we saw the market rally was actually on news that China's reserves were down less in September than they were in August, which was a strong sign that capital was not continuing to flow out of China. So supporting the argument that the policymakers aren't panicking, you did have some significant moves within the markets, and I do think you see that China is no longer recycling or buying as many dollars as they used to, and that all ties into the strength that we've seen in the dollar of late and where the economy is headed. It's clearly shifting, and it's starting shifting now. The downturn that we saw in commodity prices and currencies away from the dollar are starting to find floors, and that's what we've seen moving since the fourth quarter began. So capital is beginning to shift. The next step is going to be, how does the Fed respond, and how do we get off the zero bound? It means that we're going to see a lot more volatility, because when capital shifts, it sets off tremors within the market. We saw it with the taper tantrum. We saw it in the fall of last year on October 15th, when the US Treasury market, 10-year treasuries, went from essentially 221 to 186 in a matter of hours. Now, this is a market that we all think of as being large and liquid, that we know that bid-offer spreads on other securities, corporate bonds, structured credit, have been widening, but you don't really think about that happening in treasuries because it's generally a very tight market. But essentially what happened in October was due to the market stepping away, and when you had short covering, the ability to actually deliver the securities created tremendous demand to cover that short, and no one willing to step in on the other side. I think that volatility, in order to clear the markets and get them back to normal, is going to pick up. And while we all use the VIX as our typical measure of volatility, that equities are the best proxy for volatility in the markets. I think a measure that we all want to watch right now is actually the MOVE index. I'm sure many of you are familiar with this index, but it's Treasury option volatility. And this is as of the end of August. What you see is that it has been moving up, and it's really been hanging around its 10-year average at 99. As of the end of August, it had dropped to just below 90. It's picking up some momentum again right now, and interesting that it's doing so at a time when the VIX, after some of the movements that we saw in the equity markets last month and in August, is actually settling back down. The VIX is settling back down around its 10-year average. I think the move is important because I think how treasuries respond is going to be important to this return to normal in interest rates. The challenge being that the environment that we've had for the last several years, as I mentioned, was risk on, risk off. We've had a little bit more volatility, and we know that there's less liquidity. So when high yield is backed up, or emerging markets have backed up, there have been these limited opportunities. They've lasted really days at a time when the market sells off, but money comes in. I would characterize the current market as fairly balanced, going back to where has the capital been positioned and very sticky. Risk averse, short duration, reaching for yield. And a lot of the yield has gone away. So when the market sells off, risk on comes in and sets a price, and then the market calms down again. It happens very quickly. The challenge is going to be when negative rates of return hit traditional high quality fixed income, where is the marginal buyer going to come from? It's not me. I don't want interest rate risk in my portfolios right now because I'm thinking about that secular rise in interest rates. I'm not a market timer, and I know that if we're going off the zero bound, we're not going back. So where is the value or entry point for all of this capital that has been sitting there earning nothing? At some point, there will be a price, but for most of you out there with your clients who don't understand what's going on in the markets, it could have the potential to look as disruptive as what happened in 2008. Yet the reality is the economy's in good shape, and we're actually getting some opportunities to get credit back where it should be, and treasuries to a point where they offer value to long-term investors. So that period of time is coming, and I think it's important to think about how you want to be positioned when that kind of volatility happens. From my perspective, you want to be in fixed income strategies that have flexibility, that can sit tight during this type of market volatility because they're in fixed income securities or securities that have fixed income characteristics that have the ability to move up in price and have less interest rate sensitivity. So that really brings me to where I see those opportunities coming and where I would want to be positioned in a fixed income strategy right now. I do think overall we're always going to want to have a portion of our fixed income allocation that does play that safe haven role, that anchor to windward. But the traditional areas are going to be challenged to actually provide that over a full market cycle. So it's really cheap insurance and a hedge to have that sort of protection in a portfolio. And that's really turning the traditional allocation of emphasis on core fixed income and satellite investments, alternative fixed income strategies around the edges, whether that is a core plus, using high yield, emerging market, global bonds. All of those really come to the forefront as being part of the mix that you need to manage in a rising rate environment. Now, I run a multi-sector strategy. It's not what I would consider unconstrained, although many people will describe it as such. Unconstrained to me, I have a perception of not multi-sector total return, but the ability to go long, short, and absolute return. That is a strategy that falls into that category, and it's not something that I know how to do, although other folks I think do it well. It's less of an emphasis on return and more of an emphasis on volatility. But what's in common with multi-sector and absolute return strategies is that flexibility with the types of securities that you use. So I'm long only, total return, and when I look at where potential return opportunities are in today's environment, with that background of a U.S. that is going to continue into recovery, and I think could surprise us on the upside. I think there's a lot of dynamism, a lot of opportunity with the innovation that we have in technology. I think a lot of the M&A activity that we're seeing on the tech side right now is another strong indication that the technology CEOs see their market changing. It's right in front of us, and they're getting ready for a new environment. So the Dell EMC transaction is all about what lies ahead. I think that's really important. The world is changing very fast. That's going to give us lots of opportunities. And as hard hit as the energy sector has been, alternative energy and oil are still going to be important pieces of the U.S. economy. So within the U.S., I'm looking for opportunities that are more cyclical in nature. Those have been the credits that have been more beaten down. My exposure to commodity-related securities in the multi-sector strategy right now is close to 20%, 12% in energy and another 7% in metals and mining. I don't think we're going back to the prices that we saw back in 07, but I think with the supply contraction that we've seen recently and growing demand at the margin, the market is going to get tighter sooner rather than later. And that means energy prices are probably bottoming here, and we're going to see them move up in the next 6 to 12 months. Where do they go? I'm thinking 60 to 65. I really don't see oil moving much higher than that in the long term. It'll overshoot, but I think that's a great opportunity to get exposure to right now. In terms of currency, I think that is an opportunity. One, because I don't think the dollar is going to continue to go up. Now that is the consensus trade for 2015. Everyone is betting that the dollar is going to go up because in almost any scenario, whether it's lower for longer, and the U.S. is the only growth engine in town, everyone thinks that the dollar will continue to benefit from that position. And then you have folks who say interest rates are going up and we're going to yield more than everybody else. So money will flow back into the dollar. However, the dollar strength is starting to impact profits and earnings. And Europe is starting to recover. So when you look at the DXY, it's a basket of trade, 50% of which is tied to the euro. I don't see the dollar moving up significantly. And if global growth is better in Europe and in Asia, it's beneficial for emerging markets, and those currencies have likely seen their bottoms as well. So the currency exposure that I have today is more emerging market. We own Mexico, we own Brazil, we own India, and we own Indonesia. On the developed side, we own small Canada, New Zealand, and Euro. On the emerging market side, all of those decisions have been based on potential for reform. Now, I think that's obvious with India because there's been a very positive reform story there since the election in 2014. But I also think the fundamentals there are going to continue to be positive. A lot of that has been priced in, but you still have a currency that looks very attractive and yields that are attractive as well. Mexico, the consumer there is growing. They do have challenges with the economy. It is levered to oil. It's also levered to the U.S. I think the rising middle class story in Mexico is going to be important. And so that looks like an attractive area to invest in both the currency and the way we position it is with the local government debt. Brazil is really at the other end of that spectrum in terms of reform potential. Clearly in the headlines in a negative way, but with the potential, because they've been to, or they have achieved investment grade status, they've lost one of those investment grade ratings. They do have the potential, although Moody's has been very supportive, they've got to change their reform, their economic reform policies. And they are starting to do it. It won't happen overnight, but at local yields of 15, 16%, I think we're paid to wait for that to happen because Rousseff has been able to put levy in. He's been blocking heads with Congress, but there's a lot of pressure on Congress right now as the real came under attack from investors. The central bank has been clear. There are plenty of reserves in Brazil, and most of their debt is denominated in real, so they don't have an external debt problem. They have a big debt problem, but if they can get a handle on inflation, and they have been tightening, growth will resume. They've got a large middle class, and I think Brazil can get back on its footing and really be a emerging country that can achieve better stature in the world economy. So there are opportunities, I think, in currency. There are opportunities in the commodity-related area. And then if you want to talk about credit, it's actually interesting, and I'm sure there will be questions here. I've actually got the lowest exposure that I've had in a multi-sector portfolio to traditional credit that I've ever had. And the reason being that I want to get as far away from interest rate sensitivity, so not owning treasuries. And when I look at corporate bonds with those absolute low level of yields, I just see a lot of downside. So if you look at positioning, I'm actually using outright equity as a way to take credit risk. I'm just defining it differently because I think the fundamentals in the US economy are very positive. You're just not getting paid for it in fixed income. And with a flexible strategy, I do have the ability, with some constraints, to recognize that. So the outright equity is large cap, high quality. It's a great alternative to expensive investment grade corporates. I think we're going to get that opportunity to buy investment grade credit, all those issuers who've taken advantage of low interest rates. When we get a repricing, there's going to be a great buying opportunity in corporate bonds. It's just not today. And in the same vein, in high yield, I'm using equity sensitive converts. Home builders are a great example. I see a lot of pent up demand. I think housing is going to continue to get stronger, particularly as rates go up and access to financing gets easier because it's more profitable for the banks to lend. But if you try to take that position in fixed income today, most home builders are in the high yield market and they're trading at levels of 5 or 6%. It doesn't sound a whole lot like high yield, and I don't think these are credits that are going back to investment grade anytime soon. But you can buy home builders that have convertible bonds. That way I'm getting exposure to the equity. And yes, it's more small cap in nature, but I think that's a better proxy and alternative to where I could be investing with high yield, avoiding new issues that are really still very tied to that reach for yield. The high yield market hasn't repriced yet. So there are opportunities that are out there, they're coming. I think it's a time right now as we wait for these very important transitions, the Fed's move and China's transition to stay the course, be very patient, and be positioned to look nothing like the traditional market. I use the Gov credit as my benchmark. I think the Gov credit is going to be very challenged to provide investors good returns in the near term. So I want my fixed income to be that safe haven in a very reverse image approach. I'm in the areas that have been beaten down that have very little downside from here, and I think potentially in the volatility that we're likely to see, offer the best upside. So it's a very different way of thinking about fixed income, but I think particularly if you believe we're going back to the future and about to enter into a secular rise in interest rates, you want to think differently and you want to build in as much flexibility as you can into your fixed income portfolios. So that's a look at the fixed income markets and a little bit on the equity markets and a little bit of a trip around the world. I've talked a lot, and I would be very curious about your questions and comments.
How does Puerto Rico work out?
Puerto Rico's going to be a restructuring. We have...
But it's not contemplated in any of the statutes.
And deals must always get done in some way, shape, or form. With restructuring and our view from a firm, I do have a very tiny exposure, mainly because I'm disciplined about where I'll buy it, and it's just been very difficult to buy. Bondholders will take haircuts. So it is a restructuring, and it needs to happen, and that has been the firm view, and I think it makes sense.
Don't you think that the central bankers in the deflationary environment we've been in the last few years are setting up a scenario where it's going to be very painful for all these governments if rates rise? If the Fed has to
Do you mean emerging markets?
I mean, Japan, Europe, the U.S., if the debt rises, as you say, to a normal level, their payments in these higher debt levels is going to make government suffer. So there's a deflationary environment motivation for all of these countries to remain in this kind of environment, isn't it?
There is, but you can also look at the other side of the coin, and I would say the best way to get out of the debt burden situation, removing Japan from the equation, but thinking about the U.S. and Europe, is a little bit of inflation and a little bit of growth. We need more growth, and the potential is clearly here with technology and with energy. And what's been missing has been investment spending. If we get moving in the right direction, and I actually think inflation is starting to percolate, that will help ameliorate some of that debt burden. Now, that doesn't mean that the politicians don't have their work cut out for them, but it's not the battle that they're going to fight today. I think what we need to get through first is just getting back to normal, seeing how the markets actually respond. So I do think there's going to be a lot of volatility. It could be a very long cycle, because if the Fed has given up their flexibility for now, and we do get disruption in the markets, they're going to go back and hit the pause button. So I think we have a ways to get through it before we tackle the debt burden out there. I'm not saying I don't see it and it's not there, but I think a little bit of growth and a little bit of inflation is part of the solution.
Do you think the immigrant problems in Europe are going to cause some of this growth spurts?
I think that is
to potentially get derailed? I mean, it seems like nobody anticipated the size and the complexity of the social democracy is taking on this issue.
I think you have some interesting events happening in Europe that it's very hard to say how it's going to work out, but I think a combination of the migrants coming in and the labor that will create, the labor pool that will create, and potentially with the VW scandal, you could have some major shifts in what Europe is doing and how they're responding to the crisis. That would be greater investment and greater growth. Right now you have Germany's surplus at the highest level it's ever been. If they start needing to spend that, either to support the migrant effort or to help VW with whatever their next course is, depending on how big the charges are, you could see a very different picture quite quickly in Europe. This table is hot today.
At the CFA Institute meeting in Seattle a year and a half ago, the bond experts predicted that interest rates were going to rise sharply.
We've been saying that for a while.
And it was wrong. Yes. One, how do you account for that wrong prediction? And two, how confident are you that interest rates are going to rise the next several months?
Well, the easy answer is, going back to that chart, that the odds favor, it's been so long that they've just increased the chances that interest rates do go up. But I do think it goes to getting back to the fundamentals. I think there have been a lot of geopolitical reasons why rates haven't moved. There have been a lot of fears in the market that have distracted policymakers. I think the Fed wanted to see sufficient signs that the labor markets were moving in the right direction. But I think all those signs are there. And I think emerging markets are able, not all of them, but for the majority, I don't think there's any systemic risk, and particularly with China having stability. And that is what is starting to come out of the IMF comments from their meetings over the weekend. It's a much brighter picture, so the timing is right to begin moving interest rates up. And it'll be the US first, followed by other countries eventually. But timing is not my thing. So hopefully I'm right this time. I think the odds do favor it. Yes?
Should the Fed look at the shape of the yield curve as a way to decide when to stop raising rates? Seems like they kind of blow that off and then it kind of bites them and they're too slow to stop raising. I
think they've been slow to raise.
I'm just talking about, just like, it seemed like the last time the Fed kind of shrugged off a flat yield curve. Bernanke just kept raising rates.
Because we had the Chinese coming in and buying so many treasuries, it was tough for them to tighten to the point that they wanted to.
Yeah.
It was very difficult.
It seemed like if they could have looked at market signals, just the shape of the yield curve, they would have said, the market says we've gone too far here. So in this cycle, if they go to 50 basis points, I think that's the number you came up with.
Yeah, I don't know where the pain is for capital to really start moving, but so it's somewhere between.
The Fed doesn't seem to have a limiting, so they don't know when they've gone too far until something breaks.
Right.
So is there something that they should be looking at, or we should be looking at in terms of saying, okay, the short term has come up. Is that
the challenge with academics? They're very smart and reasonable in many ways. I think their understanding of markets is less so. That I think the data that they look at tends to be more backward looking, and they're always looking at the last problem and not being anticipatory or forward looking. So in an ideal world, yes, that might make sense, but I don't think the structure is in place for that to happen. I think they really lost their moment to be more market sensitive. Yes?
The taper tantrum gave us a little taste of what might happen. Do you think we play the taper tantrum tape again, or maybe even something that is maybe greater than that, 1.5 times taper tantrum when rates actually start moving?
I do think it's not going to look the same. The taper tantrum really hit emerging markets primarily, and we saw risk assets overall. I think the market that hasn't gotten hit yet through either the 2008 crisis or in the taper tantrum has been the treasury market. And what we're talking, and so you have a very large market with potentially a large number of sellers, that there will be a buyer at a certain point, but not anywhere close to, I think, where people envision it. So that's where I think it would be different this time. It's a market that hasn't been tested yet.
So you talk about the repricing of high yield. What does that look like to you? Is that going to feel like an event, or is that going to be something that is gradual? And how does the world change from there?
I think it's hard for markets to adjust gradually anymore because of the lack of liquidity. Even though buyers and sellers have been matched up, you've gotten air pockets. The thing about high yield, which is really interesting, it's become a much more mainstream market. You do have the dynamic now, though, if we recognize that we're going into a rising rate environment, there is the trade-off between credit, duration, and capital structure. So actually it's a triangle. And you now have a lot of focus on levered loans because of the short duration, the ability to actually get the income. I think what we'll see as we go into a rising rate environment is hopefully the opening up of the loan market to being more mainstream, and I think you will see both markets, because of the level of credit risk that's embedded in those areas, you could see whippier markets because there'll be that trade-off when investors want to either go up in the capital structure, or when they want to take duration, or when they want to shorten up. So I think it could get whippier, but is a great way in terms of total return to find opportunities. So I think we'll see air pockets that will be opportunities where you're going to want to jump in and get involved.
Do you see the volatility spilling over into equities for sure?
I think that the equity market, it really depends on what happens with inflation. I actually think the backdrop on equities is much better because valuations, if earnings continue, and I'm much more bullish there, then without inflation pressures building too much, it's really a great backdrop for equities. Would not be surprised to see any kind of a knee-jerk reaction when tightening begins, but I would view that as a long-term opportunity. I think we've got a secular bull market in equities because of what's going on in the economy for the long term, and I think there's potential for valuations to get to stretched levels, which is not where I would put them today. Yes?
How do you incorporate demographic shifts in any of your analysis?
Well, it's clearly a problem. It's a big problem in Asia. It's a problem in Japan, and it's a problem in China as well. So that is a big factor in the debt burden and how it's resolved, because you do need to have younger populations, younger demographics, and stronger growth, and able to manage that. So that long-term view on China, the mission that China's on, a big question for me is how do they deal with their demographics and with their politics? I have a hard time believing that command and control can get you to that long-term end. But that I think will be the interesting thing to see what that unfolds over the next couple of decades.
One more question.
Yes.
Also on China, there was a lot of discussion over the last couple of years about a massive real estate bubble potentially in China, and I think earlier this year we had some small builders that defaulted and then was backstopped by the government, I believe.
And they didn't treat offshore and bondholders very well.
Yeah, but then it seems like it's gone fairly quiet on that front. I just wanted to kind of see if you...
It does appear that they are targeting with they're being flexible with the currency. They're not going to let it fall. They've got a lot more wiggle room with rates to move rates down. We're going up, they're going down. And they can target where they want the banks to lend. The property sector is benefiting from that. I think it was Morgan Stanley had a great piece recently that shows you prices in all of their property markets, and that market has clearly bottomed and is on the upswing. And a stat that I read recently was a year ago, 64 of 70 cities were seeing price declines. Now all 70 cities, to varying degrees, are seeing price rises. So the bubble is not bursting yet. It's going to continue to move higher. Urbanization is what is going on right now.